why don't you all, maybe Tommy, you already introduce yourself, very briefly introduce yourselves, and we will get right into the panel.
Hi, Beth Azor, South Florida. Been in the business 37 years. I started when I was 10, and I invest in retail shopping centers, and that's me.
I think everybody's heard enough about me. Tom Wilson.
Irwin Boris. We invest in industrial, logistics, small bay flex, refrigerated warehouses.
Sarah Sullivan, Sigo Capital. We started out as multifamily syndicators, and now we're an investment firm. We have real estate funds, energy funds, and hedge funds.
I guess I will add that I didn't put in my presentation that I've been pretty equally invested in the past 20-some years in the four major asset classes of multifamily, industrial, office, and retail. So
Thank you.
I like diversity.
That's great. I want a little bit of vulnerability and honesty here. How are your deals going right now? Maybe Beth can start.
So South Florida's hot, 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 hot. We've been open since May of 2020. Our occupancy is the highest it's ever been in retail. It helps when you have 1,000 people a day moving to Florida.
How many again?
1,000 per day, and it's wealthy people. My 5 deals are all within 10 minutes of my house. The portfolio is worth $80 million, and I've sold 2 in the last couple years because I couldn't do any more with it. I believe 100% leased shopping centers, the rents are too low, and I have 4 of them today. So I'm actually putting another one on the market, and we're going to test cap rates because there's nothing available. Our investment sales community is down 80% in South Florida. We are paralyzed because of this ridiculous interest thing. Of the one property that I don't have full is I have more vacancies than I've ever had, and it's because we have parking formulas in South Florida where it limits me to do restaurants, and restaurants is the #1 use that wants to be in retail strip centers today. So I could have double the rent, but I can't do the use. So I'm lobbying the cities to, because I hear in California and Colorado they've gotten rid of parking formulas. They have not done that. So I can only lease to retail uses at that particular property where I have the 7 vacancies, which equals about 20%. And that's the one thing e-commerce hurt the most, was pure retail uses, because those are commodities, and that's, like I think it was one of our speakers said, you can't drink wine on the internet, you can't get your hair cut or your nails done, and you can't eat. So the uses that are the most sought after right now and the highest demand for space, you need extra parking. And the municipalities are kind of messing with us, developers and investors. So I would say all but one of my properties is doing great, but that one I'm prospecting over and above to try to find those pure retail uses that are really almost non-existent.
I'd say out of all my syndications and holdings, probably the only 2 that are struggling are raw land development in California. So I knew when I took them on that it's a higher risk. One of them was supposed to be assisted living, and the pandemic shut that down. So it's very, so those are the only 2 struggles. I prefer stabilized product and prefer stabilized product and small to medium value add. But scattered around the country, I have industrial and retail and office. I have office in Miami. I did lose one large tenant, but I think it's being backfilled pretty well. It's done very well. Have Power Center in Amarillo, Texas, which has 4 national credit tenants and a shadow strip next to it. It's sitting at 100% occupancy. I've got office building in Savannah that I mentioned that's 100% occupancy. So certainly agree with Neil that one of the tripwire is how long does this loan last before it rolls over. So I think that's the key in your whole portfolio is how long are you able to hang on to the loan that you currently have, and then is the lender someone that will work with you when it comes to term?
We've been blessed being in the industrial and flex space. First of all, we didn't have to absorb any of the increase in the operating costs from payroll or insurance or taxes because 98% of that is passed through the tenants through modified gross or all triple net leases. So we have everything from large 750,000 square foot single tenant spaces to 100,000 square foot space that might have 15 tenants in it. And the smaller buildings with multiple tenants actually performed well because the big players take that stuff because of the zoning and demolish it and want to build big box. So that stuff you can rent as a premium. During COVID, everybody paid on time. No one wanted to go home and work out of their garage or the basement and look at their family 7 days a week. So we were lucky with that. And so for a while, we really did nothing as rates started to move up until this past summer, as waiting for cap rates to gap out. But even with the current interest rate environment of 7 3/4 based on a 5-year SOFR loan, if I'm buying on a 9 1/4, I can still pay my investors 8.5 current. So now we're actually have a large portfolio under contract, manufacturing facilities, and several other opportunities because the cap rates have started to adjust. So if we can't pay our investors at least 8% current, we're not buying it. So we don't really have a lot of the problems that some of the syndicators had.
So in the real estate space, we have 20 apartment complexes. None of them are having revenue issues, like occupancy is fine, rent collection, all that kind of stuff. But we're in the category, a lot of people talked about it, where we bought it 3 years ago. It's time on bridge debt. It's time to get new financing, and coming in at 50% loan to value when we underwrote it, we thought we'd get 70% loan to value on our refinance. That's hurting several of our properties, so we're getting really creative. We're doing workouts with the lenders. So that's a bit stressful, that side of it. And even those that are not having issues with refinancing, some of the lenders that we used to make the purchases are now illiquid. So some of the, once we hit milestones in our business plan, they give us more money to continue at CapEx. Well, some of that's not happening, so then we're getting secondary small loans to go on top. So it's a time of being really creative around financing. But that's not the only thing, so revenue is okay, but the expenses are going up not just on the loans, but also on the property tax and the insurance being, 3 times what we underwrote it to be at 2 years ago, those sort of things. So it's a bit tricky. For our whole portfolio, I think about 25% we have cash flowing, and the rest we're holding on to distributions. So what we did last year when we saw all of these trends beginning is that we held back on making a lot of acquisitions, and we pivoted into investments that have non-correlated risks. So the 3 risks I just talked about, the insurance, the taxes, and the lending market. Okay, what can we add to our portfolio and our offerings on a personal level that doesn't have those same risks? So we went into energy, which I'm really excited about, because if you look at what's going on with OPEC and gas prices, it's looking great for domestic production. So we have some of that, so that's looking very promising. And then also continuing to look at what else is out there that has totally uncorrelated risks. So some of what Neil talked about was the volatility that's going on. So for me, I got into multifamily because it represented a peaceful investment. Okay, multifamily is peaceful, it's consistent, it's my forever thing, right? And then it became not peaceful. So what's something else that, when everything's volatile, what's something, I was thinking, what can I do to profit from the volatility and all these levers that are going all over the place? And so I learned about leverage scalping. And so if we're talking about our whole portfolio, we're also offering this to our investors. And it's active, but we have algorithms running. We have bots that are doing the trading. And that is our strongest investment in our portfolio right now because it's capitalizing on volatility and capitalizing on volume. So like August, there wasn't much going on in the world economics. It was kind of calm. We had like our lowest month. And then last month when it was like, oh, the US government's going to shut down, all the currencies went crazy, we made a killing that month. So I would encourage people to, if, you know, as for your personal self, if not in your professional business, to create a portfolio that has items that have uncorrelated risk. And things that benefit when times are calm, and also has an asset class that benefits when times are crazy, so that at least you have different levers to pull and different things to go into, depending on what's going on.
So it's safe to say that about half of us believe in focusing in one asset class. Us is self-storage, retail. Irwin, I think you do a couple of them that you focus on, and Sarah and Tom, multiple different asset classes. Can you make a case for your investing philosophy?
So I've been doing retail leasing for 37 years. So I know it, I love it, I'm great at it, but I do invest, I diversify as an LP with other GPs. So so I am an LP in an industrial deal in Tampa. I think I have 5 multifamily deals in Miami where I invest with a GP, a friend, a GP. So all my properties, my shopping centers are within 10 minutes of my house. I was telling, I think, John at my table, I do a light check. We were talking about light checks. I do a light check on my properties once a week. So that's what I know, that's what I love. I know all my tenants. I'm able to, you know, the property we're going to put on the market, we bought for 4.5, we're going to sell for 8.5. So I am very involved in what I do. And so, you know, but I do diversify.
That's awesome.
But I like to give a check and get a check. You know, GPing, it's not passive. GP is not passive.
I like diversity. I'm diversified both as a syndicator and as a LP investor. So I invest in other people's syndications and have diversity that way. Regardless what you're in your case, you're very hands-on, whereas I started choosing markets that are spread around. So it's too big a scale and too far for me to do that. So, you know, having outstanding partners and experts in each of those areas. So basically, I'm entrusting their ability to manage these different asset classes. So I just like the diversity. And I guess another driving factor, in addition to my own personal interest and preference, was that as my business, syndication business grew, it initially was mostly in Dallas-Fort Worth, and initially, you know, 1 or 2 asset classes, residential, one. And as the business grew, my investors started saying, oh, Tom, I really like what you're doing, but, you know, I think I've put enough money in this region and in this asset class, and I want to be able to have some diversity. So for my own personal investing and for my syndicators who wanted diversity, that's when I started reaching out and finding other markets and other asset classes. So it was largely in response to what my investors told me they wanted.
No, we do have other assets, hotels, apartment buildings, office buildings, but it's all about cash flow and it's about basis. So right now, given where interest rates are, we're not looking at those, but we are looking at apartment development using modular because I can build it faster and more cost effective. So that when we're looking at the upper Midwest and some of the new markets for modular multifamily, because of the need that's there, you know, just as Neil said, there is a huge demand for that. But historically, most of our investors on our syndicated deals are investing for current cash flow. So that's sort of left out extreme value adds. And working with a lot of family offices and high net worths who look for cash flow, and that's how they take care of their philanthropic needs. It's cash flow. You never spend your principal. That's where our focus has always been on the cash flow. But it is good to be diversified, to have exposure to multiple asset types. And one of our offices actually does a lot of Broadway show productions and has won 2 Tonys, but that's not something I would personally invest my money. I don't know anything about it, and it's either feast or famine or something like that.
I'd say similar to Tom, our investors wanted different markets, different asset classes, different cash flow versus appreciation versus tax advantage. So it was kind of out of service that we ended up diversifying. On the personal side, we're more diversified, but as far as in the business, it was really trying to get 3 buckets of offerings so that we could serve investors better. That's really why we did that. Yeah.
Okay. In 2018, 2019, 2020, what was going on through your head, and what is going on through your head right now with regards to investing in real estate?
Do you want to start at the other end?
Yeah, let's go, Sarah.
Why you think? And
Yeah.
you and I get to think about this.
Yeah, so for me, I'm pivoting a bit. So instead of being an operator, being on the loans and the earnest money deposit and all of that, and being really at risk in that GP seat, pivoting more towards being a fund manager and having funds so that we have a say in what goes on, but we're not as at risk as the primary sponsor, just because there's so much more volatility in that way. Kind of have a broader selection instead of just what I can actively get under contract. That was the question, right? Like,
What were you?
So before I was like, yeah, I want to be like fully do soup to nuts. So 18, 19, 20, I was like soup to nuts. I'm doing it all. Need to have it all, in-house under my umbrella. And now it's like, I want to do this one piece and have partnerships that do the other harder part because things are getting harder and you need different areas of expertise. It was much easier 18, 19, and 20 to kind of get away with it.
I guess 17, 18, and early 19, we were actually aggregating. We were in multifamily. We had 5,000 units in Raleigh, Charlotte, and Wilmington. And 19 to 20 into early 21, we were a big net seller because I had institutional partners, and when they say sell, you really don't have an opportunity to do anything else but sell. But we also did a lot of acquisition on older industrial, looking at it more as a covered land play, where buildings had a lot of excess land. Like we bought a 250,000 square feet on 60 acres outside of Syracuse. So dumb luck is we're down the block from where the new Micron plant is supposed to go. But now we're busy getting that out of wetlands so we can actually build on it because nothing's been built up there. So it's interesting. We tend to look at things that are out of favor and what we're buying and where we could actually generate cash flow. But you need the diversity.
Yeah, we were buying heavily in the teens there post crash, and then as cap rates were coming down, once we got into 20 and on, the cap rates were coming down to a point where we just couldn't justify holding on in this seller's market. And just like I said before about the risk of selling too soon, the advantage is that you take the profit, you might lose a little bit, but boy, as soon as we hit the beginning of 2023, I remember having some discussion with my partners during the different properties that we were selling, thinking, gosh, are we selling too soon? If we hang on to this, get more money for our investors. And I thought, no, I think it's time to take some money off the table. And boy, was that ever a good decision. We sold 11 commercial products during the pandemic, and it was so glad we did. So I'm sitting mostly in a liquid position on the sidelines right now, waiting for opportunities. Opportunity comes along, I'm fine to do it. But a nice part is when you're private, and unlike say Wall Street, you don't have this mandate that you shall deploy this much money every month or every quarter, and kind of forced to buy things that might not make sense. Whereas on the private sector, we can decide to say no. And so I think unless it's really good, I think build to rent is like Neil's doing is a nice model, but this got to be in the right market and the right kind of product even for that to work. So I think it's cautious time, but now as prices start to drop and in certain sectors, I think I'm ready to buy.
I was finishing a development, and then I was doing a new development in 18, 19, 20. And now I wouldn't touch a development. Development's dead in South Florida, which is great because that means our rents are going up, which they are. The demand from the tenants is through the roof. Never in 37 years have I seen this kind of demand. It's because of the wealth that came to South Florida after the pandemic. And as you know, since 2020, I'm on a mission. And my mission is there's more than 10 women in this room next year. of all of the commercial real estate investors, the stat is of all commercial real estate investors, 3% are women, and 50% of that 3% are spouses and inherited. So 1.5% we represent, and so we've got to get more women in the room and at the table.
Another interesting fact like that, which shocks a lot of people, is that I've read that out of all the real estate agents in the United States, there's only about 2% who are investors.
Yeah.
Isn't that insane?
This is legal
Insane.
insider trading in the retail world. I mean, the amount of people that, rep Starbucks and then find a site for Starbucks and puts the two together and hands it to a male developer. I love my male developers, but I'm pushing, trying to inspire women that we can invest too. We just don't need to be investing in the stock market.
Yeah.
So so all you guys bring your daughters and your sisters and your mothers and your wives here next year.
I was the first person in my last high-tech company that brought their daughter to work when they started the, bring your daughter to work.
And if you want to quick...
Excuse me, may I ask you a question of
Yeah.
what killed development in South Florida?
Construction costs and interest rates. I had a deal, do we have time for a quick?
Yeah.
Vacant Wells Fargo in South Florida, A-plus real estate, had it under contract for $2.5 million, 3,400 square feet. I beat 14 bidders out by only $1,000, so not like billions, I didn't overpay. And had a national coffee, a national Mexican fast food, and a national Asian fast food, all dying for the real estate. And the impact fees from the city were $500,000. The construction costs were $2 million more than I budgeted. I went back to the 3 retailers and said, so sorry, I'm going to drop the contract. And they said, we'll go from 75 triple net to 100. And the numbers still didn't work. The construction costs and the municipality impact fees are killing development, and the interest rates. So I was going to buy it with cash. I was syndicating the deal. I raised $3 million in 2 weeks, and I had to wire all those people all their money back. And they said, and I thought they were going to be so upset, and they said, we're going to give you double the next time, which I was like, why? But they trusted that I didn't close on a bad deal. But it's no development, but great for us that own real estate because our rents are increasing.
The value of trust from long-term relationships is just immeasurable, isn't it? Yeah.
Irwin, I saw you speak at a panel at a family office a few weeks ago, and I thought you were the best speaker there. That's why you're here.
Thank you.
And thank you for coming. And you said at the panel to throw IRRs out the window right now. Can you please elaborate?
No, that's true. I guess as an investor, when you look at the way highly syndicated deals are advertised, it's always here's what the projected R is, here's what the preferred return is. And I'm always like, so where's the cash flow? What are you projecting you're going to distribute year 1, year 2, year 3? Because we all know that, man makes plans and God laughs. So the one thing I can guarantee you is every IRR that's in an offering book is wrong. Sometimes some of them are going to beat the pants off it, and some of them are going to make it, and some of them are going to fail miserably. And so, people say to me, like on this panel, what's a bad investment? Well, I know contractually, it's a 9 cap. We took some financing. We're going to distribute 9% the year 1. Rent's going up 3% a year. Think of your weight compounding 3% a year for 10 years. You're going to be pretty fat at the end of 10 years. and we're going to sell it for our basis. I said, could you live with that? And a lot of people say, yeah, that's pretty good. You beat the Treasury, you got the tax benefits, it's fine. So I think that, especially now, eyes wide open, people need to focus more on cash on cash. Look at the IRR, but eyes wide open, look at what the cash flow is, because IRR doesn't buy groceries, it doesn't buy gas, it doesn't pay your bar bill. At least if you're getting cash flow can get reinvested and compound itself to generate more cash flow. And so if you're someone that's looking to gain wealth, but not spend your salary on luxury items, cash flow can spend on the luxury items, and you could bank some of what you're making on your W-2 or on your other investments. So I think you really need to have a balance, and cash flow will always be something that we focus on.
Thank you.
Yeah.
Sarah, you were doubling down in multifamily or residential, 2018, 2019, and now it's time to find other things and pivot. And you were mentioning that you were doing something else as well on top of multifamily. Can you share a little bit about that?
Yeah, definitely. So I hit on it a little bit. And can I share a resource with people as well?
Sure.
If you guys want to go to sarahschecklist.com, we have an ROI calculator that goes through like a whole bunch of different alternative assets to talk about the difference between cash flow, preferred return,
I'm going to go there.
ARR, tax benefit, because I think a lot of people, they start to know about one thing, and then when you start introducing other terms, or they might play out it might be the same term, but you get the money at a different time with a different investment. So anyway, that sarahschecklist.com, it has that in a tax worksheet so that you can see how tax advantages of energy and real estate can help you in your portfolio and tax strategy. But I say that because that's how I start all of my investor conversations, is with those two resources. And I ask them what their goals are. And so right now, a lot of people are saying my goals are cash flow, cash flow, cash flow. And since the real estate, at least the area that I'm in, is not high cash flow, I was looking for cash flow. And so a lot of you are familiar with the concept of day trading, where, if the market's going like this, you do a bunch of trades and you make money on the swings that are happening during the day. You return to a cash position at the end of the day, and you've made a few points. Well, we learned a few strategies like that using gold and foreign currency, foreign exchange, forex, and using leverage, and we were seeing really strong results. And so we went out to our investor base, and I said, sorry, we're not providing great cash flow in our real estate right now, but we have this other thing we're doing personally, would you like it? And we had 500 people put in soft reserves, and for something that wasn't even created yet, for an idea. So I said, okay, so we'll create it. And so we ratcheted down, but we have algorithms running. We have algorithms doing this trading, and it does over 1,000 trades a month, more, and they're smaller risk trades, so we ratcheted down the risk so it could be really consistent, so that it produces consistent cash flow for our investor base who does want to live on cash flow, and they still want to have real estate in their portfolio, but there's this other investment that they can make to have the cash flow in the interim while things are not as strong right now in the cash flow space. And it might not be very long that we can do this because it's an algorithm, and we're developing AI so that the algorithm gets smarter and smarter, so the returns can stay at low risk but get higher and higher. But I predict that there's some point in the next 3 to 5 years that the government's going to somehow get in and say, like, no, this is not allowed, somehow, shut it all down. But either find someone who's doing it because it's extremely, extremely lucrative, or find someone who has a coaching program. We went through a few coaching programs, and we're like, wow, you can make a ton of money in like an hour a day. And I don't do it personally. I'm the real estate and energy side, but my husband does it. He's a computer engineer. And so it's just really, it's really fascinating, and it's a strategy. So like in the casinos, the house always wins, right? Because they follow the rules. And so when you turn on an algorithm, it follows the rules, and it always wins. And when you're emotionally trading, it doesn't always win. That's what we found out. But the algorithm always wins. So that's what we have. That's our new thing. Yeah.
She's a real Bay Area girl. That's how we talk.
Yes, I always believe that cash flow is indeed king. I I was going to quip that after Neil's talk, I ran outside and I bought some more gold and I bought some Xanax. One time I was talking to Andy Tan, I think his name is, having dinner with him, who is Robert Kiyosaki's securities advisor. And I said, so tell me, what do you think about this gold thing that Robert promotes and a lot of others do? And he says, I see it. I think it's an insurance policy, and some hope it can be an appreciation. He says, there's one thing I don't like about it. What's that? He said, there's no cash flow. There's no cash flow.
That's why Robert says your house is a liability, not an asset.
That's right. Yeah.
I have a question for Beth because I know that Hi, Mom.
Yes.
Insurance rates are going up in Florida and Texas. I've heard of people that their insurance went up 10x. I forgot which state it was. How are people dealing with that in Florida?
10x, jeez.
So again, we're insulated in South Florida. My insurance went up $1.20 to $4.50. So we sent letters to our tenants. They're all triple nets, thank God. And we said, dear tenants, unfortunately, 12 carriers left the state, 2 went bankrupt, our pool has been diminished to, 3. And here is your legislature. Please write and call them because they will listen to you, the business owner, more than they will listen to us, the property owners. And I have 101 tenants. They all paid immediately, except one called me. But I collect sales from all my tenants, and I know where their occupancy costs are, so I knew I wouldn't have a problem collecting. Because, again, back to the wealth driving into our market, our sales are through the roof. So they ended up paying it. But we're fighting it. We collectively, property owners are fighting it. My guess is Citizens will come back in, which is a government state insurance company, and I just heard last week that they predict it's going to go up another 30% next year.
Well,
So,
Depends on the storms.
yeah.
So far, we've been
Well,
lucky.
and one of my properties I don't have a mortgage on, and my partner and I decided 4 weeks ago in our renewal to go without wind coverage. So for 4 weeks, we have 4 weeks left of hurricane season. But yeah, so we made that decision. Because our deductible is $700,000. It's even though we have a fully triple netted tenant base, the deductible is on us.
Yeah, I did something similar with one of my only properties, no investors involved. It has been doubling every year for the last 2 years to go liability only.
Yeah, we just added to our lease form, even though we're 100% leased, but through renewals or through if any tenants leave and we get new tenants, that the tenants will participate in the deductible.
if your properties are triple net, you pass it on to them and do the best you can to support that. And but if it's not triple net, then boy, you just take it in the shorts. It's a tough situation.
That deal that I'm selling for $8 million, what I bought for $4 million, were all gross tenants. And I was able to, in the last 3 years, convert them all to triple nets.
Mm-hmm. Mine went up 4x in Miami. Mm-hmm.
Tom, you have had a few partners throughout your career. Tell us maybe your top 1 or 2 advice in determining a good partner.
Have a good woman in your life who can go judge the character of the partner. It's really, that's the tough part, isn't it? Trying to judge character. I say probably almost half the syndication I've done have been with one partner who happens to be in Dallas-Fort Worth. And he and I would trust each other with our family or goal, whatever. He's just an incredible partner of both competence and character. I've had I had one partner with a product back in Atlanta that sold and overachieved its performance goals. And we second deal had done with them, multifamily, and they ran off with a profit. Ran off with a profit. So, I'd say out of, 27 deals I've done, I've only had, syndication only had three real problems. I think this was going to work out all right, but just to put it in perspective, how much responsibility you take on with, with getting with partnering with somebody. This particular one took a year and 7 attorneys in 5 states and $250,000 to bring them to the table. And we've got a third of it back, with the rest of it promised at the end of the year. Got them to sign on it, but it's when you have a problem like that, and it's I'd say the best asset I've ever had have been outstanding partners, and the worst is a couple of bad ones. And it's I don't know if I know enough now. I wish I could say I did to be able to do a better job, other than just be more careful and do more vetting. And
When I'm going to do an LP investment, I ask the GP to give me names of investors that are no longer investing with them.
Oh.
That is, and then if they don't, then I don't invest. And I mean, I have LPs that no longer invest with me, and I'll tell everyone who they are, and there's reasons why they don't. They're going to do GPs themselves, or what, they have kids, they didn't have kids and now they have a family with college. So I am very happy to give all of my investors former LPs, but I think that's a good way to try to vet.
It takes a lot of vetting, and of course, the best way is to go network around. When you have a community like this, it makes it a little easier, because our community is not that large, and I think having some connections and networking yourself to find out the reputation of them is a very important thing to do. And it's but it seemed everything was fine with this one that had the problem with. They've done 20 big multifamily projects throughout the Northeast, and been around for a long time. And what they did was allegedly arbitrage the profit into another deal that they thought they're going to pull it out of. The economy took a dive, and they lost the money, and so they're scrambling to pull it back.
Sounds like jail.
Sarah, you were going to say something?
Yes. So a lesson I learned is to be aligned on goals. So I have a partnership that I'm trying to separate from right now because I didn't do this. We had like growth goals, but actually when you talk to someone about their goals, it tells you a lot about them. So their goals are 3 billion AUM. My goal is 300 additional investors served this year. That's really different, and it leads you to make different choices. And so they might be making choices that are not profitable for us, that are not profitable for the investors, that are really too risky, all these things, because they have a goal of a number of AUM versus a service-oriented goal. And we're definitely separating ways, but since that partnership, I begin every partnership conversation with what are your goals, and that'll tell you a lot about their personality. Is their goal money? Is their goal service? Is their goal something they can post on social media, which is the case I'm talking about? And as long as they're aligned, if your goal is 3 billion and their goal is 3 billion, great, you're a good match. But I would make that suggestion.
And I'd say the LPs are partners too, and I've turned down investors because I thought they'd be a problem, or they were putting too much of their assets into deals.
Oh, yeah.
So they're our partners too, right?
Yeah.
And that's it's important to select good partners and the LPs. Yeah.
Irwin, you're too quiet today.
No, a lot of it is reputation. You're going to talk to the brokerage community, you're going to talk to the lenders, you're going to talk to current and past investors. We have some full cycle deals that we keep purposefully in a war room. Everything from the original closing statement to the monthly reporting through the cycle to the sale. You want to check my IRRs? Feel free. Your reputation in this business is everything. You just need to, be transparent, good, bad, or ugly. And I do know from some of our investors who are in multifamily that are getting those capital calls, Never has any syndicator or sponsor said, we underestimated the increase in construction costs. No one's willing to take any responsibility. It was always 100% on one of 6 or 7 other, items that was beyond their control. You just say, look, it was beyond our control, but because we didn't budget. The one thing I did notice, because we do have some multifamily, is that expenses just grew a lot more than income. So, it just happened. So it's about transparency, it's about monthly reporting. When I send out a monthly reporting packet, people say, what is 10 megabytes? I said, well, you got a balance sheet, general ledger, P&L, bank statement, invoices, mortgage statement. What do we need to read? I said, you can read the narrative, but I don't want you to tell me I didn't give it to you.
Yeah.
So, ask questions, feel free.
Well, I wish we had more time. Are you all staying after 6 o'clock? If you have
Yes.
any questions for each asset class or their investment thesis, please go speak with them. Thank you so much, everybody. I really appreciate your time.